What's going on, guys? I want to give you guys the number one rule when it comes to learning how to day trade, or if you're starting to scalp, and whether that be options or stocks, whatever you guys are trading, I'm going to give you guys the number one rule, and that rule is risk management. Guys, without risk management, you will never actually be able to grow an account. You will never be able to actually become profitable. Because here's a problem that a lot of newer traders have, right? Let's say you're a newer trader and you start with, say, $1,000, right? And you're going to trade options contracts and you're looking around, and let's say you want to play something like AMD, right? So AMD is a semiconductor stock. It doesn't move too fast. It doesn't, it's not too extravagant, and the options premiums are not that expensive to trade. So as a newer trader, something like this might, kind of suit your risk appetite to what you think. So let's say, for example, one options contract is trading at around $200 to $300 for something close to the money. If you guys don't know what options contract strike prices are, I would definitely recommend going to like a website like Investopedia. Look up, just Google around what is a strike, what is an option, so forth and so forth. But I'm assuming that you know a little something, at least the basics about options. But let's say you get started with $1,000. You see that one options contract cost estimated, $200 to $250. So the first thing you start thinking is, well, I can buy 2 to 3, maybe even 4 contracts here, and if this move works in my favor, I could double my account. I could make $500. I could make $2,000, $10,000. You see all this stuff posted on social media where you see a bunch of people making YouTube videos how they started with $100, turned it into 10,000, or 10,000 into 100,000. But you don't actually know how long it took them to actually learn the strategy, what else goes involved with like the emotional side of trading when you are actually playing, with your own hard-earned real money, this, that, and the other. So risk management is going to be the number one thing that you need to focus on. It's not focusing on how much money you can make. It's focusing on how much money you're going to lose, right? So if you have a $100 account, I would definitely not recommend going out and buying 2, 3, 4 options contracts, because let's say that you are wrong in the move that you took. Well, then you could essentially, on an options contract, that contract could essentially expire at zero if you let it, go all the way to expiration and it never actually hits your strike price. So let's say, for example, you don't let it hit zero, but you do take a pretty significant loss. Let's say, according to your strategy, you enter into the play and you're going to buy for the stock to go higher. The stock does go higher. You don't take any profits because, the profit margin wasn't that, it wasn't good enough that you felt like the trade just started to work in your favor. And let's say something happened where the market pulls in aggressively, and now this options contract turns negative, it goes red, and it's working against you, say 20, 30%. Well, if you go in with the $1,000 account and you risk, let's say, $800 to $1,000 on that account in one particular play, then essentially you can lose $200 to $400 sometimes on these plays in a matter of minutes, if not hours. And if you have $1,000 account, it only is going to take 2 to 3 losses before you completely blow up that account, which means that you never actually give yourself enough time and enough trades to start building momentum. So first things first is I would definitely recommend starting with one options contract. Okay. Let's assume that you have an account size of, let's say, $1,000. I would recommend trading no more than one options contract that costs no more than $150, right? This is just my personal preference. You can go a little lower than that, you can go a little higher than that, but the majority of what I'm trying to say is I would buy no options contract that's going to cost me more than $150, because at this kind of risk management, you can afford to get in 7 or 8 plays and really start to test your strategy, really start to take profits, really learn to keep those losses small. So, versus entering in on one play, losing 50% of that on one particular play, you could essentially wipe out $1,000 account. Versus if you take one options contract that, say, cost $150, even if you lose 50% of that move, you're only losing $75, which means that essentially you have 9 more trades that you can make before you actually blow up your account. And that's one thing that a lot of people do not understand, especially when they're trading options. They say, I got $1,000. Let me go buy this one options contract. Let me go trade Tesla because I know Tesla moves, really, really big. And I see all these people making a ton of money off Tesla. The thing is that maybe you have to buy an out of the money contract on Tesla that costs $1,000 or $900. Tesla can quickly reverse on that move if it is incorrect, and immediately you can be down $300-$400 on that one particular play very, very quickly. So with that being said, you can only really afford to take 2, maybe 3 plays. And if you do have a cold streak, like we all have cold streak, no one's ever going to win every single play that they're in. In fact, you might actually break even or lose more trades than you actually take. But the whole idea when it comes to trading is being able to keep those losses very, very small and allow those winners to really, really stretch, right? So if you play one options contract and you're giving yourself, let's say 40 to 50% risk on that one options contract, meaning that if the move doesn't work in your favor, the max you're willing to lose on that one particular contract is going to be $75, right? That's half of 150, maybe $60 to $75. With that being taken into account, you'll be able to extend the amount of trades that you'll be able to take and give yourself the numbers more time to work in your favor. So where do you take profits if you're only taking one options contract? How much can you expect to make? Well, if one options contract is going to cost you $150, I would personally believe that a good profit take would be anywhere, and this is how I play, but I also play with a larger account size. So for example, everyone's account size is going to be different. Someone who makes $1,000 a play or $500 a play, and someone who's making $25 or $50 a play doesn't necessarily mean that someone else is better than the other. It just has to do with their account size. So if I was particularly trading a one contract that cost me $150, my profit take would be anywhere between 40 and 60% on that options contract. And I would continue to hold that trade and let it run until I make at least 60 to 80, $85, $60, $70 on that one particular trade. So this way, if you do lose on your account and you're only losing, let's say $50 or $60 at a time, well, then that extra time that you win is always going to outweigh the times that you lose. So, if you trade options contracts, sometimes you can get into a contract and it can quickly go up 80, 90% in a matter of a couple of hours, depending on the momentum and the trend of the day. Just speaking from experience, from a risk to reward ratio, risk to reward factor, even taking one contract and allowing yourself to lose 50% of that contract, which is $75, is a lot. Okay. So there's a lot of people that might cut their plays at 15, 20%. Maybe you lose $20, $30. The thing with trading options contracts versus trading stocks is that these contracts can fluctuate $20, $30 in a matter of seconds on a matter of a few ticks in the market. So you kind of have to let those contracts work a little bit. You can't really say like, well, if I invest $150, I'm only going to give myself a $20 risk. You can lose $20 in a matter of 2 or 3 minutes. And then 5 minutes later, the stock price completely bounces and goes up higher and you would have made 60, 70, 80% on that options contract. So that's the only reason why I kind of say, hey, you know what? Risk 40 to 50% on that one options contract. But here's where it gets a little tricky. You don't want to risk 40 to 50% of that options contract if you're investing $500 or $1,000 and you only have $1,000 account. Because if you think about it, if you risk 40 to 50% on an options contract on Tesla that let's say cost $1,000, now that's $400 to $500 on that total play, right? But if we look at it from the flip side, if you were playing Tesla one contract at $1,000 and let's say you get a 20% return, well, $200 is really, really good. Think about how many people go to work every day and don't actually make $200. So the risk to reward ratio is kind of skewed, right? Why would you risk $400 to $500 to only make $200? That does not make sense. So when you put it into that context, that doesn't make sense. So that's why knowing risk management and knowing how much you actually want to risk according to your account size is huge. Guys, this is just very basic and very short video. I can go on for hours and hours and hours and talking about different factors with risk management. But if you guys are interested in trading options or day trading, or you want to start learning about this, definitely join my Discord. That link is down in the description box below. And if you're kind of looking to get a little bit more serious and maybe you would like a list of stocks that you can trade day in and day out and kind of know what stocks I'm trading at what particular levels, or maybe you guys would actually like to learn a strategy, visit my website at evolutiontraders.com. That link is also in the description box below. I guarantee I'll help you out, help you understand the process, and we can all make money together. With that being said, guys, I'll see you guys all on the next trading video.